Question 1. An investment advisor representative, IAR, has taken custody of a client's funds due to a special circumstance. Under the Uniform Securities Act, what is the IAR generally required to do regarding these funds? A. Maintain a net worth equal to the amount of the funds. B. Notify the administrator promptly and arrange for an independent audit. C. Place the funds in a separate brokerage account registered in the IAR's name. D. Obtain written permission from the client to hold the funds indefinitely. Answer: B. Notify the administrator promptly and arrange for an independent audit. When an investment advisor representative, IAR, or investment advisor, IA, takes custody of client funds or securities, it triggers specific regulatory requirements designed to protect the client. Under the Uniform Securities Act, the IA/IAR must promptly notify the administrator and typically arrange for an independent public accountant to conduct an annual surprise examination of the assets, ensuring they are properly held. This rigorous oversight is crucial because taking custody significantly increases the risk of misuse or misappropriation of client assets. Remember, safeguarding client assets is paramount, and custody rules are among the strictest. Question 2. Which of the following statements best describes the primary distinction between a broker-dealer and an investment advisor? A. Broker-dealers always charge commissions, while investment advisors always charge fees. B. Broker-dealers primarily facilitate securities transactions, while investment advisors provide advice for compensation. C. Broker-dealers must register with the SEC, while investment advisors must register with state administrators. D. Broker-dealers are fiduciaries, while investment advisors operate under a suitability standard. Answer: B. Broker-dealers primarily facilitate securities transactions, while investment advisors provide advice for compensation. The core difference lies in their primary function and how they interact with clients. A broker-dealer's main role is to execute trades, acting as an agent or principal in securities transactions, earning commissions or markups/markdowns for these services. Conversely, an investment advisor's principal business involves providing advice about securities for compensation, which subjects them to a fiduciary duty. This distinction is fundamental to understanding their respective regulatory obligations and relationships with clients. Keep in mind that a firm can, and often does, operate in both capacities, requiring dual registration. Question 3. Under the Uniform Securities Act, an individual who provides investment advice solely regarding U.S. government securities for compensation would typically be categorized as which of the following? A. An investment advisor. B. An investment advisor representative. C. Excluded from the definition of an investment advisor. D. Exempt from registration as an investment advisor. Answer: C. Excluded from the definition of an investment advisor. The Uniform Securities Act specifically excludes certain entities and individuals from the definition of an investment advisor, meaning they are not subject to IA registration requirements under the Act. One key exclusion is for those whose advice relates solely to U.S. government securities. This is an important detail to remember, as it distinguishes them from typical investment advisors who provide advice on a broader range of securities. This exclusion reflects the perceived low risk associated with U.S. government debt. Question 4. An investment advisor suggests a complex option strategy to a client. The client experiences significant losses due to the strategy's inherent risks, despite the advisor fully disclosing all risks involved. Which of the following best describes the advisor's potential liability? A. The advisor is liable because complex strategies are inherently unsuitable for most clients. B. The advisor is not liable if the strategy was suitable for the client's objectives, risk tolerance, and financial situation. C. The advisor is liable only if the client can prove intentional fraud or misrepresentation. D. The advisor is not liable because the client acknowledged the risks. Answer: B. The advisor is not liable if the strategy was suitable for the client's objectives, risk tolerance, and financial situation. An investment advisor operates under a fiduciary duty, which includes ensuring that investment recommendations are suitable for the client. Suitability means that the advice aligns with the client's financial situation, investment objectives, and risk tolerance. If the advisor conducted thorough due diligence on the client's profile and recommended a strategy that was indeed suitable, despite subsequent losses, the advisor has generally met their fiduciary obligation. Disclosing risks is important, but true suitability goes beyond mere disclosure and requires a reasonable belief that the recommendation fits the client. Question 5. Which of the following is considered unethical conduct for an investment advisor under state regulations? A. Recommending a diversified portfolio of mutual funds that includes funds from various fund families. B. Charging a performance-based fee for managing a large institutional account that meets specific criteria. C. Engaging in churning, which involves excessive trading in a client's account to generate commissions. D. Disclosing potential conflicts of interest to clients in writing before engaging in transactions. Answer: C. Engaging in churning, which involves excessive trading in a client's account to generate commissions. Churning is a classic example of an unethical and prohibited business practice for investment advisors and broker-dealers alike. It involves an advisor recommending or executing an excessive number of trades in a client's account, not to benefit the client, but primarily to generate additional fees or commissions for the advisor. This violates the advisor's fiduciary duty to act in the client's best interest. Always prioritize the client's needs over your own compensation. Question 6. The Capital Asset Pricing Model, CAPM, is used to determine the expected return on an asset, given its risk. Which component of CAPM represents the asset's sensitivity to market risk? A. The risk-free rate. B. The market risk premium. C. Beta. D. The expected return on the market. Answer: C. Beta. In the Capital Asset Pricing Model, CAPM, beta is a measure of an asset's systematic risk, or market risk, indicating how much the asset's price tends to move in relation to the overall market. A beta of 1 means the asset's price moves with the market, while a beta greater than 1 suggests higher volatility than the market, and a beta less than 1 suggests lower volatility. Understanding beta is crucial for investors to assess how a specific investment contributes to the overall risk of their portfolio. Question 7. Which of the following would cause a client's net worth to increase? A. Paying off a mortgage loan. B. Selling an asset for less than its book value. C. An increase in the market value of investments held. D. Incurring new credit card debt. Answer: C. An increase in the market value of investments held. Net worth is calculated as assets minus liabilities. An increase in the market value of investments held directly increases a client's assets without affecting liabilities, thereby increasing their net worth. Paying off a mortgage reduces a liability but also reduces an asset, cash, resulting in no change to net worth, assuming the cash was already an asset. Selling an asset for less than its book value would typically decrease net worth, and incurring new debt increases liabilities, decreasing net worth. Question 8. An investment advisor has developed a wrap fee program. Which of the following statements is true regarding this program? A. It typically involves a single fee covering both advisory services and transaction costs. B. It requires the advisor to register only with the state administrator, regardless of assets under management. C. It is generally only suitable for clients with very small portfolios due to its simplified fee structure. D. It mandates that all trades be executed through a specific broker-dealer affiliated with the advisor. Answer: A. It typically involves a single fee covering both advisory services and transaction costs. A wrap fee program is characterized by a single, comprehensive fee, often an annual percentage of assets under management, that covers both investment advisory services and brokerage transaction costs. This structure is designed to simplify client billing and potentially reduce the incentive for churning, as the advisor's compensation isn't tied to the number of trades. Advisors offering wrap fee programs must provide clients with a specific disclosure document, Appendix 1 to Form ADV Part 2A. Question 9. An investment advisor provides advice to a publicly traded mutual fund. Under the Investment Advisors Act of 1940, how would this advisor generally be classified? A. A federal covered advisor. B. A state-registered advisor. C. An exempt reporting advisor. D. Excluded from registration as an investment advisor. Answer: A. A federal covered advisor. Under the Investment Advisors Act of 1940, an investment advisor that provides advice to a registered investment company, such as a publicly traded mutual fund, is typically classified as a federal covered advisor. This means they are required to register with the SEC, regardless of the amount of assets under management. This is one of the key criteria for determining whether an investment advisor falls under federal or state jurisdiction. Question 10. When calculating the net present value, NPV, of a project, the discount rate used is typically the A. Risk-free rate. B. Required rate of return or cost of capital. C. Expected rate of inflation. D. Historical average return of the market. Answer: B. Required rate of return or cost of capital. Net present value, NPV, is a capital budgeting tool used to analyze the profitability of a projected investment. The discount rate, often referred to as the required rate of return or the cost of capital, is used to bring future cash flows back to their present value. This rate represents the minimum return an investor expects to earn to compensate for the time value of money and the risk associated with the investment. A positive NPV generally indicates that the project is expected to be profitable. Question 11. Which of the following regulatory documents must an investment advisor deliver to a prospective client at least 48 hours before entering into an advisory contract, or at the time of contract entry if the client has a right to terminate without penalty within 5 business days? A. Form U4. B. Form ADV Part 1A. C. Form ADV Part 2A, brochure. D. Form 13F. Answer: C. Form ADV Part 2A, brochure. The Form ADV Part 2A, often called the brochure, is a crucial disclosure document that investment advisors must deliver to clients. It contains important information about the advisor's services, fees, disciplinary history, conflicts of interest, and other material facts. The 48-hour rule, or 5-day right of rescission, ensures that clients have sufficient time to review this information before committing to an advisory relationship, promoting transparency and informed decision-making. Question 12. A portfolio manager consistently achieves higher returns than the market without taking on additional risk. This outperformance, when attributed to the manager's skill, is often referred to as A. Beta. B. Standard deviation. C. Alpha. D. R squared. Answer: C. Alpha. Alpha is a measure of an investment's performance relative to a benchmark index, accounting for the risk taken. A positive alpha indicates that the investment or portfolio has outperformed its expected return given its level of systematic risk, beta. This outperformance is often attributed to the investment manager's skill in security selection or market timing. Think of alpha as the extra return you get beyond what passive market exposure would provide. Question 13. Which of the following financial professionals is not excluded from the definition of an investment advisor under the Uniform Securities Act? A. A bank. B. An attorney providing incidental investment advice. C. A publisher of a general circulation financial newspaper. D. A financial planner whose primary business is providing comprehensive financial plans including investment advice. Answer: D. A financial planner whose primary business is providing comprehensive financial plans including investment advice. The Uniform Securities Act provides specific exclusions from the definition of an investment advisor. These exclusions typically include banks, certain professionals, like lawyers, accountants, teachers, and engineers, whose investment advice is solely incidental to their professional practice, and publishers of bona fide newspapers or financial publications of general and regular circulation. A financial planner whose primary business involves providing investment advice for compensation would almost certainly meet the definition of an investment advisor and be subject to registration. Question 14. Which document outlines the investment advisor's fiduciary duty to clients and is used for registration with the SEC or state administrators? A. Form 10-K. B. Form ADV. C. Form S-1. D. Form N-1A. Answer: B. Form ADV. Form ADV is the uniform application form used by investment advisors to register with both the Securities and Exchange Commission, SEC, and state securities authorities. Part 1 of Form ADV collects background information about the advisor, while Part 2, the brochure, is the primary disclosure document provided to clients, detailing the advisor's services, fees, disciplinary history, and the crucial fact that they operate under a fiduciary duty. This form is central to the regulation and transparency of investment advisors. Question 15. An investment advisor representative, IAR, is determining the suitability of a recommended investment for a client. Which of the following factors is generally considered least important? A. Client's current income and net worth. B. Client's investment objectives and risk tolerance. C. Client's social security number. D. Client's time horizon for investments. Answer: C. Client's social security number. When assessing suitability, an investment advisor representative must gather information about the client's financial situation, investment objectives, and risk tolerance. This typically includes details like current income, net worth, existing investments, time horizon, and specific goals. While a social security number is necessary for account opening and tax reporting, it is not a direct factor in determining the suitability of an investment recommendation itself. Focus on the financial and personal aspects relevant to investment choices. Question 16. Under the Uniform Securities Act, an investment advisor, IA, is generally permitted to disclose a client's confidential information to a third party under which of the following circumstances? A. To a marketing firm to solicit new clients, provided the client's name is anonymized. B. When legally compelled by a court order or regulatory request. C. To other clients of the IA to demonstrate successful past performance. D. To an affiliated broker-dealer for cross-selling purposes without explicit client consent. Answer: B. When legally compelled by a court order or regulatory request. Investment advisors have a fiduciary duty to maintain the confidentiality of client information. This duty can only be breached under very specific circumstances. One such circumstance is when the advisor is legally compelled to disclose the information, for example, by a court order, a subpoena, or a request from a regulatory authority, like the administrator. Absent such compulsion or explicit client consent, client information must remain private. Question 17. Which statement accurately describes a characteristic of a qualified retirement plan? A. Contributions are always made with after-tax dollars. B. Earnings grow tax-deferred. C. Withdrawals are tax-free in retirement. D. It does not require IRS approval. Answer: B. Earnings grow tax-deferred. A defining characteristic of qualified retirement plans, such as 401(k), and traditional IRAs, is that earnings on contributions grow tax-deferred until withdrawal in retirement. This means that taxes on the investment gains are postponed, allowing the money to compound more effectively over time. While contributions to some qualified plans are pre-tax, tax-deductible, and distributions are typically taxed as ordinary income, the tax-deferred growth is a universal benefit. Question 18. An investment advisor uses a quantitative model that measures a portfolio's systematic risk relative to the overall market. This metric is known as A. Alpha, B. Standard deviation, C. Beta, D. Duration. Answer: C. Beta. Beta is the primary quantitative measure of a portfolio's or security's systematic risk, which is the risk that cannot be diversified away. It indicates how sensitive the portfolio's returns are to movements in the overall market. A portfolio with a beta of 1.2, for example, is expected to be 20% more volatile than the market, making beta a crucial tool for risk management and asset allocation. Question 19. An investment advisor is compensated based on a percentage of assets under management, AUM. This compensation structure generally creates a conflict of interest related to A. The advisor's incentive to recommend high-commission products. B. The advisor's incentive to encourage clients to invest more assets. C. The advisor's incentive to engage in excessive trading, churning. D. The advisor's incentive to invest in illiquid securities. Answer: B. The advisor's incentive to encourage clients to invest more assets. When an investment advisor is compensated based on a percentage of assets under management, AUM, a natural conflict of interest arises. The advisor has an incentive to encourage clients to invest more assets or to discourage withdrawals, as this directly increases their compensation. While this structure generally reduces the incentive for churning compared to commission-based models, the AUM model creates its own unique conflict that must be disclosed and managed ethically. Question 20. Under the Investment Advisors Act of 1940, which statement is true regarding the brochure rule? A. It requires an advisor to deliver its Form ADV Part 1 to all prospective clients. B. It mandates that all performance data must be audited annually by an independent third party. C. It ensures clients receive a written disclosure document, the brochure, detailing the advisor's services, fees, and conflicts of interest. D. It applies only to state-registered investment advisors, not federal covered advisors. Answer: C. It ensures clients receive a written disclosure document, the brochure, detailing the advisor's services, fees, and conflicts of interest. The brochure rule is a cornerstone of client protection under the Investment Advisors Act of 1940. It requires both federal covered and state-registered investment advisors to provide prospective and existing clients with a written disclosure document, Form ADV Part 2A, the brochure, that details essential information about the advisor's business practices, compensation, disciplinary history, and potential conflicts of interest. This ensures transparency and helps clients make informed decisions. Question 21. An investment advisor has discretionary authority over a client's account. This means the advisor can determine which of the following without prior client approval for each trade. A. The type of security to buy or sell, the amount, and the price or time of execution. B. The type of security to buy or sell, but not the amount or time of execution. C. Only the timing of trades, not the security or amount. D. Only trades involving options, not stocks or bonds. Answer: A. The type of security to buy or sell, the amount, and the price or time of execution. Discretionary authority grants an investment advisor the power to make investment decisions on behalf of a client without needing to seek explicit permission for each specific trade. This power of attorney typically includes deciding what security to buy or sell, the quantity, and the timing/price of the transaction. For an account to be fully discretionary, both written authorization from the client and approval from a principal of the firm are required. Remember, ABC for discretionary authority, activity, buy, sell, and how much control. Question 22. A client is concerned about purchasing power risk. Which of the following investments would be most susceptible to this type of risk? A. Short-term U.S. Treasury bills. B. Common stocks with a high dividend yield. C. Long-term fixed income bonds. D. Real estate investment trusts, REITs. Answer: C. Long-term fixed income bonds. Purchasing power risk, also known as inflation risk, is the risk that inflation will erode the value of an investment's returns over time. Long-term fixed income bonds are particularly susceptible because their future interest payments and principal repayment are fixed in nominal terms. If inflation increases significantly, the purchasing power of those fixed payments decreases, reducing the real return on the investment. Equity investments and shorter-term instruments generally offer better protection against inflation than long-term fixed-income securities. Question 23. An investment advisor manages client assets using a strategy primarily focused on undervalued securities with strong balance sheets and consistent earnings. This approach aligns with which investment philosophy? A. Growth investing. B. Value investing. C. Momentum investing. D. Index investing. Answer: B. Value investing. Value investing is an investment philosophy that focuses on identifying and purchasing securities that are trading below their intrinsic worth. Value investors typically look for companies with strong fundamentals, such as solid balance sheets, consistent earnings, and low debt, but whose stock prices may be temporarily depressed due to market sentiment or other factors. The goal is to profit when the market eventually recognizes the true value of these companies. Question 24. A client, aged 30, asks an investment advisor for advice on saving for retirement. The advisor should generally recommend a portfolio that emphasizes A. Capital preservation and high-quality fixed income. B. A balanced mix of equities and fixed income, with a slight tilt towards income. C. Growth-oriented investments with a higher allocation to equities. D. Investments primarily in money market instruments for liquidity. Answer: C. Growth-oriented investments with a higher allocation to equities. For a young client, aged 30, saving for retirement, there is a long time horizon before needing the funds. This long horizon allows the client to tolerate more short-term volatility in exchange for potentially higher long-term returns. Therefore, a growth-oriented portfolio with a higher allocation to equities is generally suitable, as equities historically offer the best potential for long-term capital appreciation, allowing for compounding effects over decades. As the client approaches retirement, the allocation would typically shift towards more conservative assets. Question 25. Which of the following would be found on a company's balance sheet? A. Revenue. B. Net income. C. Retained earnings. D. Earnings per share, EPS. Answer: C. Retained earnings. The balance sheet is a financial statement that provides a snapshot of a company's financial health at a specific point in time, following the accounting equation, assets equals liabilities plus equity. Retained earnings are a component of shareholder equity, representing the cumulative profits of the company that have not been distributed as dividends but instead reinvested in the business. Revenue, net income, and earnings per share, EPS, are all found on the income statement, which reports financial performance over a period of time.